Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are going to discuss the theory aspect of Chapter 9, which is on current liabilities and long-term debt. And for this particular video, we're going to concentrate on the current portion of long-term debt. Okay, so remember, it's easier to learn something when you can associate it to something else. If you have to learn something from scratch, it's a lot more difficult, right? So what I'm going to do here is I'm going to associate, the current portion of long-term debt to what happens on our assets. Okay. Now, if you recall, on our assets, we have cash, we have things like accounts receivable, we have inventory. Okay. Marketable securities, blah blah blah. But the whole idea here is that these are like current, right? You can think of those as short term. Then we have, our fixed assets, like property, plant, and equipment. Okay, these are long-term assets. Okay, and from a liability side, you have the same liability. Come on, Jim, spell right. Liability. There we go. From a liability side, you have the same type of structure. You don't just have liabilities, you have current, and then you also have your long term, right? And when you think long term, you can think of long term in terms of, say, a mortgage, right? And from a current perspective, you can have something like your accounts payable or even a notes payable if it's a short enough term, right? So when you're looking at the structure of a balance sheet, your assets is equal to your liabilities, right here, and then plus your equity, right, which would be here, right? And so that's kind of like the structure. You should already be somewhat familiar with all of this, right? But for this here particular video, what we want to, what I'm going to stress or show is this idea of the current portion. Okay. Now, remember when I say liabilities, the first thing that comes into mind is accounts payable. Okay. And the second thing that comes into mind might be a note payable. And the third thing that might come into mind is the mortgage, right? And mortgage payable. And these are the first things that pop into your mind when you think of liabilities. Okay, but realize again that they're arranged on your balance sheet just like your assets are arranged from the most liquid to the least liquid. And the liquidity is the conversion to cash. So cash is the most liquid, so that's why it's the first thing on your on your balance sheet or your trial balance. And then as we go through, remember you have like accounts receivable. That's pretty liquid because you can call those in. Your marketable securities, which would be someplace right in between, is very liquid. You just call your broker and you cash out. Inventory, it takes a little bit of time to sell off the inventory, but if you have a flash sale, you can sell it off relatively quickly. So you're talking about liquidity. Over here in your liabilities, you have the same aspect. Your accounts payable is generally for 30 days. Okay, your notes payable is anything greater than 30 days, right? But it goes all the way up to like 1 year. And of course, anything greater than that, anything greater than 1 year, is, you know, a long-term debt, something like your mortgage, right? So, you know, you're probably saying, oh, why is he going over all of this? I already know this kind of stuff and blah, 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 right? Because you've been exposed to it already, right? This is not new information. Just realize that you have to start thinking in you know, even though you know a lot of this stuff, you have to start thinking in terms of what is the current portion, okay, of your liability. And this is the crux of this video. The current portion is considered, and this also applies to your assets, is considered between now and 12 months from now, okay? So if I have accounts payable, right, well, that's 30 days, right? That's within 12 months. If I have a notes payable, that's say 60 days or 3 months or 6 months, right? You know, that's, you know, the is considered a current portion because it's within 12 months, okay? But now what happens, what do you do when you have, and as I have this here as an example, you know, you're going to buy a building, and then let's say the building costs 120,000, and you're going to put down a down payment of 20,000, so your mortgage is going to be 100,000. That's 120 less the 20 gives you $100,000 is what you're borrowing. Okay, that's going to be your mortgage payable. Okay, and as we already showed, we would consider that to be long term because why? We're going to finance it for 10 years, right? Now, to keep numbers simple, I'm not going to do, you know, I'm not going to look at the present value and calculating interest and blah, 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 blah. All right, I'm just going to keep things relatively simple here, right? I have a mortgage for $100,000 and it's for 10 years. So that's 10,000 per year, right? Um, I should have used a different set of numbers here to try to make this a little bit easier because now I have to divide. All right, no, I don't have to. All right, I'll keep it at that. I'm not going to look at it from a monthly perspective. So, you know, we're going to end up paying 10,000 per year for 10 years. Okay. Now remember, I'm not looking at this from calculating interest and trying to get exact numbers. What I'm trying to do here is I'm trying to illustrate this idea of the current portion. All right. So if we're looking at our balance sheet, okay, we're going to have our liability section. I can't spell liability today for some reason, right? So in our liability section, we're going to have our accounts payable, we're going to have our notes payable, and then we're also going to have our mortgage payable. Now, these are going to be general ledger accounts, okay? And the balances in those accounts are going to be whatever they are going to be, right? So for our mortgage payable, we're gonna, when I buy this building and I make the journal entry, I'm going to have a mortgage payable for 100,000. So I'm going to erase this just a little bit to make it easier to see. I'm going to call this mortgage payable for 100,000. Okay, so my accounts payable, let's just call that, say, 3,000. My notes payable, let's call that 10,000. All right. It doesn't really matter about those right now. But the whole idea is when I, excuse me, when I buy this building, I'm going to have a mortgage payable liability account for $100,000. Now, when I make my payments, right, whatever those payments are going to be, let's just say it's $1,000 a month. Again, I'm just making this up here, okay? I'm not doing the exact numbers. But let's say my monthly payment's 1,000, and let's say 300 of that is for interest, okay? As I make those monthly payments, okay, I'm going to make an entry against my interest, and I'm going to also make the entry for the $700 against the mortgage payable here, right? And so as I make those payments, that's going to reduce my mortgage payable by whatever amount that is. So let's say after I made that first payment, of $700, I'd have $99,300 in my mortgage payable account. Okay. So what ends up happening is you're actually, you're keeping track of exactly how much is owed on your mortgage payable just by virtue of the fact that you're making those payments and you're making the journal entry. Now, and this is where it becomes a little bit sticky, in that that's on your trial, that's on your trial balance. Okay, it's in your general ledger accounts. We do not create an account for the current portion. We do not do that on our books. Okay, what ends up happening is at the end of the accounting period, when we're making, we have to close out our books, okay, and we create our financial statement, right? What we end up doing is we end up rewriting, for lack of a better word, our balance sheet. Okay, if we put on our balance sheet our accounts exactly the way they're listed on our trial balance, they would look like this. All right. However, what we do is we rewrite the balance sheet in order to take into consideration what the current portion is. So if I have this here mortgage payable, right, for $100,000, and I'm financing it for 10 years, right, that means that it's, $10,000 per year. So in my first year, so in year one, is owed $10,000. Now remember, the current portion is between now and the next 12 months, right? So if I have this mortgage payable for 100,000, right, and I divide it up into 10 different 1, 2, 3, 4, 5, 6, 7, 8. Let's go like this: 9, 10, 9, 10. If I'm, visually, if my whole mortgage is 100,000, okay, this first year here is $10,000, right? All the remaining is 90,000, right? Okay, we got that. Okay, so what we do is we have to rewrite. Now remember, we're not making journal entries for this. All we're doing is just adjusting our balance sheet physically. Okay, I mean, you could possibly create the accounts in your general ledger accounts, but what's the sense? You have to make the entry, an adjusting entry, post it to the ledger account, create your balance sheet, and then immediately reverse the entry, all right, post it to put your books back exactly the same way, just to be able to make your balance sheet look like the way you want it to. So instead of doing the ledger accounts, and adjusting, making those extra entries, and therefore increasing the likelihood of an error and blah, 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 blah. When it comes to creating your balance sheet, what you end up doing is in your current portion, your current liabilities, you physically write in current portion of mortgage payable. Now, that current portion is $10,000, okay? And because I am physically increasing that, I'm physically moving $10,000 to my current portion, what I have to do is, I mean, I can't just add, because then that throws my accounting equation out of balance. So if I'm adding the $10,000 here as the current portion in order of the mortgage payable into the current liability section, well, in our long-term liability section, I have to take it out. So what ends up happening is I have to do a mathematical calculation. So I move one column to the left, and then I put less current portion of mortgage payable, right? So that's $10,000, okay? And since in mathematical calculation, that I have to show the $90,000, okay? So what does this do all for me? Well, you know, I'm able to see that my mortgage payable at this moment in time, okay, is 100,000, okay? And I'm also able to see that the that's 100,000, and I'm also able to see that the current portion is 10,000, which allows me also to be able to see that the long-term portion is 90,000. All right, and no, again, I'm just, you know, this is just a, you know, a manual entry to my balance sheet. It's, you know, you've learned so far to create your balance sheet in a specific way, all right? But now what I'm saying here is that, oh, well, it, you know, you have the ability to go and say, ah, I need to take out this current portion and put it into my current liabilities here. But when I do that, I also have to, you know, add to my balance sheet to be able to take it out. And now what it does is it gives me all of this here additional information. Everything's getting a little sloppy here, so let me erase some of it. What it does is it gives me additional information on my balance sheet that allows me to be able to perform a much more accurate analysis. Okay, when we get to the focus on decision making at the end of the chapter, you know, we'll be looking at ratios that have to deal with, you know, our long-term debt. Okay, and we also have to, you know, our current liabilities. Well, you have to make sure that, what is, you know, when we're looking at it, what is current, all right? And let's say, for example, you know, our current ratio, all right? And, you know, here's an example. Our current ratio, remember this from, you know, previous chapters, you know, that's current assets divided by current liabilities. Well, what are my current liabilities? Remember, it's how much in assets we have to be able to pay off our liabilities. Well, what's our current liabilities? Our current liabilities are not just this 3,000 and this 10,000. The current liability, so it's not 13,000, right? No, it's 23,000 because we have this here $10,000. That's a current portion of that uh, mortgage payable. And of course, when you plug, you know, that number into your current ratio, that's going to change the value of that ratio. So when we're looking at, you know, things from a day-to-day, you know, general ledger account perspective, yeah, we're going to have, you know, our accounts payable, we're going to have our notes payable, and we're going to have our mortgage payable, okay? And they're going to have balances in those accounts. Again, we don't want to create new accounts just to be able to figure out the current portion. When we go to do our balance sheet, we can manually add in, you know, we can manually do the math to figure out what our current portion of our long-term uh, liabilities are and make the manual entry in order to be able to reflect it on our balance sheet the proper way so that we can do the correct analysis when it comes to, you know, needing the information for our ratios. Okay, if I didn't do this, if I didn't do all of this for this mortgage payable, then my current ratio would not be correct. All right, and that's the reason why we're doing all of this. It's being able to present the information so that whoever's looking at the books right, can readily, whoever's looking at the financial statements, can readily see and be able to analyze the information for themselves. Okay, so I hope that made a lot of sense. I know that this here is kind of like sloppy. I've got a lot of arrows and stuff like that. But hopefully, you had, got the idea here, all right, and the reasoning why we're doing what we're doing. Okay. Um, the big takeaway from this is that when we're looking at our long-term debt, we have to figure out what our current portion is. And when we figure out what that current portion is we have to reflect it on our balance sheet by adding it in. We're going to add in the current portion into the current liability section, and because we are manually adding in that amount here, we have to take it away somewhere else. So we take it away from that particular liability so that we have, for lack of a better word, a book value for what our long-term portion of the mortgage, that long-term liability is. So we're able to see how much we still owe on the mortgage, but we also see how much that current portion is. And of course, that allows us to be able to know what the difference between our current and our long-term is on that particular liability. Okay, so that's it for this video. If again, pause, rewind, watch the video again if you're not understanding something. And if you still don't get it, feel free to telephone and speak with an instructor. Okay, so I'll see you in the next video for estimated warranty liabilities.